Stop listening to the soft landing narrative for just 5 minutes. I need you to shut out the noise from CNBC and look at the raw data that Wall Street is actively ignoring. Because what happened this week wasn't just a market fluctuation. It was a structural break in the global financial order that has held the world together since 1945. We have always feared that China would weaponize their holdings of US debt. We spent decades worrying that Russia would dump the dollar to hurt the West. But we were looking in the wrong direction. The attack didn't come from an enemy. It came from our closest ally. It came from the one nation that the US financial system relies on to keep interest rates low. Japan has officially begun the liquidation of United States Treasury bonds. This is not a drill. This is not a theory. This is a mathematical inevitability playing out in real time right before our eyes. And the terrifying part? They aren't doing it to hurt us. They are doing it to save themselves. They are drowning. And to keep their head above water, they have to push the US economy under. If you hold dollars, if you have a 401k, or if you are planning to retire in the next 10 years, you are standing in the blast radius of this decision. Today, I'm going to show you exactly why Japan's collapse triggers a US hyperinflationary event, and why physical silver is the only asset class that stands outside this burning building. To understand the gravity of this, we have to strip away the complex economic jargon and look at the raw mechanics of what is happening in Tokyo right now. Japan is trapped in what economists call a doom loop. For 30 years, they printed money to keep interest rates at zero. They invented the concept of quantitative easing. They thought they could defy the laws of economics forever by printing money to buy their own debt. But in 2022, the game changed. When the US Federal Reserve started raising rates aggressively to fight inflation, the gap between US rates at 5.5% and Japanese rates at 0% became too wide to sustain. This created the unwinding of the greatest trade in financial history, known as the yen carry trade. For decades, investors would borrow money in Japan for free because interest rates were zero, and invest that money in US Treasuries to earn a yield. It was free money. Trillions of dollars flowed into US debt this way. Japan was essentially funding American spending. But now that flow has reversed. Capital flows like water. It seeks the highest yield. Investors sold the yen and bought the dollar. This crushed the yen. We watched it fall from 110 to 130, then to 150. Now, as we break past 160 yen to the dollar, Japan faces a nightmare scenario that no central bank wants to face. Their currency is becoming worthless. Remember, Japan has almost no natural resources. They import everything. They import their oil, their natural gas, their food, and their raw materials. And all of those commodities are priced in US dollars. When the yen falls, their import costs explode. Inflation in Japan is becoming severe. The population is panicking. The cost of living is destroying the middle class. The Bank of Japan has exactly two choices, and both of them lead to disaster. Choice one is to raise interest rates to make the yen attractive again. Choice two is to sell their savings, which is US debt, to buy yen and artificially prop up the currency. Here's why this is a catastrophe for you and the United States. They cannot press choice one. Japan's debt to GDP ratio is 260%. That is the highest in the developed world. If Japan raises rates to even 1% or 2%, the interest payments on that massive national debt would consume their entire national tax revenue. They would go bankrupt instantly. Their banking system, which holds all this low-interest Japanese debt as collateral, would implode. It would make the 2008 Lehman Brothers crisis look like a picnic. So they are forced by survival to press choice two. They have to sell their foreign reserves. And what is the biggest asset in their reserves? $1.1 trillion of US Treasury bonds. Mainstream financial news will tell you, don't worry, the market can absorb it. That is a lie, and I can prove it with data that they aren't showing you. To understand why Japan selling is so dangerous right now, you have to understand the liquidity vacuum. Imagine the US Treasury market is a giant bathtub. For years, the water level, which represents liquidity, was high because the Federal Reserve was pumping water in via quantitative easing, and foreign nations like China and Japan were pumping water in by buying debt. The tub was full, so the government could float endless amounts of new debt. But look at the state of the bathtub today. First, the Federal Reserve is no longer pumping. They are draining water out via quantitative tightening. They are selling $95 billion a month off their balance sheet. Second, the US government is running a deficit of $2 trillion a year. They are dumping massive amounts of new debt into the tub, requiring more water to float it. Third, the Reverse Repo facility, which acted as an emergency reserve tank of $2.5 trillion, has been drained completely dry as of this month. The tub is empty. The buyers are gone. And precisely at this moment of maximum vulnerability, Japan, the whale of the market, decides to dump massive blocks of treasuries. This is simple supply and demand. When you have a flood of supply from US government spending, Fed selling, and now Japan selling, meeting a vacuum of demand, the price of bonds must crash. And in the bond market, when prices crash, yields explode higher. We are talking about the 10-year Treasury yield spiking not to 5%, but to 6%, 7%, or even 8% in a matter of weeks. You might be thinking, I don't own bonds, why do I care if yields go to 8%? Because the entire US banking system is built on the lie that Treasuries are risk-free assets. This is the hidden cancer in the system. Remember Silicon Valley Bank? They collapsed because the Treasury bonds they held lost value when rates went up. Now imagine that happening to every single bank in America simultaneously. US banks are currently sitting on over $600 billion in unrealized losses on their bond portfolios. That number is based on rates at 4.5%. If Japan's selling pushes rates to 6% or 7%, those unrealized losses balloon into the trillions. The banks become technically insolvent overnight. They won't be able to lend. The credit cards stop working. Small businesses get their lines of credit cut. The economy hits a brick wall. This isn't a recession forecast. This is a depression mechanic. And there is another layer to this that makes it even faster than 2008. Algorithms. In the modern market, humans don't execute the trades, machines do. These algorithms are programmed to watch liquidity. When Japan sells, they don't just sell at the market price. They sell to defend their currency, meaning they sell aggressively regardless of price. This creates gaps in the order book. The high-frequency trading algorithms detect this liquidity gap instantly. Their logic is programmed to sell first and ask questions later. This creates a gamma squeeze to the downside. We saw a preview of this in the UK gilt market crisis a few years ago. The market went no bid. That means you try to sell your bond, and literally nobody answers the phone. The price goes to zero effectively. If the US Treasury market goes no bid because of Japan, the entire global financial system halts. No collateral for loans, no mechanism for trade settlement. It is the financial equivalent of a cardiac arrest. So, Japan is pressing the button. The algorithms are ready to cascade the selling. The banks are sitting on a powder keg of insolvency. What happens next? What is the inevitable reaction from the only entity that can print infinite money? This leads us to the terrifying reality of the Fed pivot, which won't be a celebration. It will be a surrender. We need to talk about the reverse repo facility, because this is the invisible dam holding back the flood, and almost nobody outside of institutional trading desks understands its significance. Throughout 2024 and 2025, the Federal Reserve has been draining liquidity from the system via quantitative tightening. They have been selling bonds off their balance sheet to fight inflation. But the market didn't crash. Why? Because the Treasury had a secret weapon called the Reverse Repo facility. You can think of this as a giant savings account where money market funds parked excess cash overnight to earn a risk-free return. At its peak, it held over $2.5 trillion. Throughout 2025, whenever liquidity got tight in the banking system, money flowed out of this reverse repo facility and back into the market. It was a buffer. It was a cushion. It was the only reason the stock market remained stable while rates went up. Here is the terrifying part that the data released this morning confirms. As of January 2026, the reverse repo facility is empty. It has been drained down to zero. The cushion is gone. The buffer is depleted. We are now flying without a net. And now, at the exact moment the buffer disappears, the biggest foreign holder of US debt, Japan, starts selling aggressively. This is the definition of a liquidity crisis. There is no excess cash left in the system to absorb $100 billion of Japanese selling per month. Who buys it? If the reverse repo is empty, and the banks are full of bad debt, and China is selling, and now Japan is selling, who is the buyer of last resort? There's only one answer: the Federal Reserve. Jerome Powell will have to pivot. He will have no choice. The bond market is mathematically broken without a buyer. Let me give you the numbers that keep Fed officials awake at night. If yields spike to 6%, the US government's interest expense on its $35 trillion debt exceeds its entire defense budget. If yields go to 7%, the interest expense consumes 50% of all tax revenue. The government ceases to function. The banking system collapses again, just like Silicon Valley Bank, but on a national scale. The Fed will be forced to step in. They will have to restart quantitative easing. They will have to print money to buy the bonds that Japan is selling. This is the yield curve control scenario everyone feared. But it's not just a theory anymore, it's the only mathematical exit. When the Fed pivots this time, it won't be because inflation is low. It will be because the Treasury market is dying. They will be printing money into an inflationary spike. That is the recipe for hyperinflation. That is the Weimar dynamic. Printing money to buy your own debt while your currency is losing value is the exact mechanism that destroyed the German mark in 1923. It is the exact mechanism that destroys every fiat currency in history. Now you might be asking, why silver? Why not just buy gold? Look at what happened to silver prices during every major currency crisis in history. In 1970s America, when we lost the gold peg and inflation roared, silver went from $1.50 to $50. That is a 30 times return. In Weimar Germany, silver purchasing power exploded while paper marks became wallpaper. Why? Because silver is the people's money. It is accessible, it is industrial, it is monetary. While central banks hoard gold, the public runs to silver because it is the most undervalued asset on the planet relative to the money supply. Right now, the gold to silver ratio is sitting near 85. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio reverts to about 15 to 1. Geologically, it's about 8 to 1. Even if we just go back to the 2011 high, silver needs to triple from here. But if we enter a monetary reset, if the dollar loses its reserve status because allies like Japan are dumping it, the ratio could compress violently back to historical norms. That would imply a silver price not of $50, but of hundreds of dollars per ounce. Furthermore, the fundamentals of silver are screaming at us. The industrial demand for silver is already outstripping supply. Solar panels, electric vehicles, advanced electronics, 5G towers, they all need silver. Silver is the most conductive metal on Earth. There is no substitute. We have been in a structural deficit for 4 consecutive years. The mining supply is flatlining. The above-ground stockpiles are draining. The COMEX inventories are near record lows. And now you add a monetary panic. You add investors fleeing the dollar because the Japanese carry trade is unwinding. You have the perfect storm for a silver squeeze that makes 1980 and 2011 look like warm-ups. This isn't about getting rich quick. This is about survival. It's about not going down with the ship. When Japan sells treasuries, they are effectively shorting the US dollar. They are saying, we can't hold this asset anymore because it is toxic to our survival. If our closest ally can't hold US debt, why should you hold US dollars? Why should you keep your wealth in a currency that is being debased to bail out a broken bond market? So, what comes next? Watch the 10-year yield. If it breaks 5.5%, the panic begins. Watch the Bank of Japan. If they announce another rate hike, the carry trade implodes instantly. And watch the Fed. The moment they announce any form of liquidity support or balance sheet stabilization, that is the signal. That means QE is back. That means the dollar is being sacrificed to save the bond market. And that is when silver goes vertical. The window to position yourself is closing. The smart money is already moving. Central banks are buying gold at record paces. Smart investors are stacking silver. The masses are still asleep, believing the soft landing fairy tale. Don't be the masses. Wake up. Look at the data. Japan has started the avalanche. The snow is already falling. Get your house in order before the avalanche hits the valley floor.